Let's talk about candlesticks, and I will show you the maybe 20, 30, 40, we will see, I don't know by now, best candlesticks and how to trade them or how to analyze them. And I'm starting here on a daily, on a weekly chart, but we will go through all the different time frames. It doesn't really matter where you look for them. The context matters and the interpretation matters, but it doesn't matter which time frame. You can use this on the 1 minute, on the 5 minute, on the monthly, on the yearly, on the weekly, on the daily, on any time frame that you want. You can use candlesticks. And I am a big fan of using candlesticks or looking for candlesticks where it actually makes sense. So at turning points or after trending moves, at moving averages, as pullbacks, as continuations. So we have a pin bar here, and the context of the pin bar is even more interesting. So the market is in an uptrend, very clear uptrend, wave 1, wave 2, wave 3. And now in wave 3, it does make sense to slowly start looking for a reversal or a pullback, especially because here we are in Forex market. Forex is a mean reverting market. So in contrast to stocks, the trends in Forex don't tend to last for a very long time. So it doesn't make sense to look for mean reverting setups. And if you can find such a nice pin bar after such a big trending move on a higher time frame, go to a lower time frame and try to find patterns and try to time your entries. Another very different scenario is here. You can see the market was coming from an uptrend, reversed, and then crossed above the 50 period moving average, traded back into the 50 period moving average for the first time, and then pulled away again. So now looking for pullback opportunities at the 50 period moving average here, you see there is a very, very strong engulfing candle. So this green candle completely engulfs the previous red candle, right where it makes sense, right at the moving average. So this is where to look for candlesticks. It does make absolute sense to see an engulfing there, whereas it doesn't always make sense to look for engulfing patterns everywhere, or in general, it doesn't make sense to trade candlesticks at random price levels or at just in the middle of nowhere. But when you can see that they happen after trends, in big trending moves, at pullbacks, at moving averages, at support and resistance, like for example here. So we can clearly see that around here there was a big resistance level, which then here resistance, which turned into support, and here resistance again. And how does it look? This candle is another engulfing bar. So it completely engulfs the small previous red candle. There's also the component of a very strong wick rejection, and it does make sense to look for a bullish sign after such a long trend. And you can see the market then reversed, and at the core and at the origin of those reversals, there's often those very interesting pin bars or engulfings or whatever, but in any case, look for a meaningful candlestick pattern. Let's take a look at a range market example, and let's go to a lower time frame here. So it makes sense if you're trading a range to obviously define the boundaries of the range and then look for candlesticks at the boundaries. So here you can see we have a clear trap pattern trading above the previous highs. A lot of people will put their stop loss above those highs, and when you see such a trap pattern, the market takes out the previous high and immediately falls back into the range. It makes sense to look for trading opportunities on the lower time frames away from that range. And here you have this crazy, very nice looking trap pattern. So very, very nice. And you can see here as well, the market then reached the previous lows of the range. And you can see if we extend that, this has been a very, very important level. It seems like in the past, support, 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 turns resistance, becomes support again. And then here the market gives us a doji. This is the daily chart. So this happened 1.5 days ago, and it set the tone for yesterday's very strong bullish day. Let's take a look at another example. Let's move to a higher time frame. And here, first of all, what can we see? That the market is here in something like a channel or wedge or whatever you want to call it, doesn't really matter. And here at the downside and at the bottom of this trend line, you suddenly see last week, because this is the weekly chart, last week was an inside candle. And it makes sense to look for then in the current week for continuations, which is actually exactly what happened. So after an inside candle, after a multi-wave downtrend, you can see that 1, 2, 3, 4, 5 trend waves into a downtrend. It makes sense to look for reversals, especially when they come with such a nice inside bar. And you can see previously the market was in a downtrend, obviously 1, 2, 3. Then here we have correction wave 4. And how does the correction wave 4 look like? We can see that here was a very nice pin bar. Pin bar takes out the previous highs, sets up a trap, and then is the signal and the starting point for 2 weeks of bearish price action. So the higher time frame sets the stage for the lower time frames, as always. Here the Euro US dollar, very similar, or not similar, but is also an interesting setup. You can see very long uptrend, 1, 2, 3, depending on how you want to count the waves. Maybe you count it like this, 1, 2, 3, 4, 5. And then at the core and at the top you can see first one inside candle, then here a small hammer or doji, and then here at the top you can see a pin bar, a trap pattern taking out the previous highs, and this sets then set the tone for this huge bearish week. So just by being identify this weekly pin bar here at a previous resistance after such a long trend, you can then go to the lower time frame and trade 1 week of bearishness. And on the lower time frame, this is from 122 to 1. This will be a few hundred pips. So looking at the daily time frame and allowing you to set the direction is a very important concept. And this is at the core of one of my trading strategies. I call it a daily bias. And the daily bias is a multi-time frame approach where you have your higher time frame, where you pick the direction based on a few criteria, and then you go to the lower time frame where you then execute your trade. On the lower time frame, you look for very specific entry points based on some confluence factors, and here you set the direction. On the higher time frame, here you execute your entries and you time your entries. And this is very similar to obviously this video, but this video is just a very brief introduction. Make sure to check the link in the video description below. Here as well, it makes sense. You can see after the market has topped out here, we have 1, 2, 3, 4, 5, 6, 7 downtrending waves, more or less, depending on how you want to count. And you can see how did the market top out, or bottom out in this case. Very shallow. If you put a RSI indicator on here, you will see that this is a clear divergence. And then you have 2 very strong pin bars here. And you can see pin bar 1, pin bar 2. And you can see that initially the market did not move, but then after the market took out the highs, we had a huge push last week. So again, this would have then been good for a few hundred pips. And it's a very simple but very effective way of looking at price action. Let's take a look at this example, and again we have a few different things to explore here. Here, for example, another push in an uptrend. The market is clearly in an uptrend because the price is above the 50-period moving average. Clearly an uptrend, and then on a pullback into the 50-period moving average, you have this huge engulfing candlestick. And again, this engulfing candlestick as a pullback would have then signaled 1, 2, 3, 4, 5 weeks of bullishness and a few hundred pips. And then here at the top, you're entering a divergence late in a trend. And you can also see we have 2 pin bars, very strong rejections here. And again, on the lower time frames, this then could have been used for timing entries. US dollar Swedish krona, which is something that I've traded last week, but I want to take a look at something different. So the market arrived back at the moving average here, a crossover of both of the EMA and the MA50. Interesting pattern. And how did it reach the top? It reached it with this doji pin bar. And again, clear exhaustion that this uptrend here is not seeing a lot of support, was never able to break above the moving average, and then it was followed by so far 1 week of bearishness. And again, it may look small, but keep in mind this is the daily chart, and on a lower time frame, this may have been good for a big move. So a higher to lower time frame is always quite an interesting scenario. Here, pretty much the opposite. The market is in a long downtrend, and then here at the bottom of the downtrend, you can see where are we. The price is reaching here into this demand area. Bear almost touched it. Let's look a little bit closer and see. Let's actually see and look into this pattern to pinpoint the exact demand area. So where do we have the breakout? Okay, here seems to be the breakout. So here is the actual demand area. If you have watched my previous supply and demand videos, you always want to look for the first consolidation before a huge breakout in a new trend. And obviously it fulfills all the criteria, because as we've seen on the daily chart, a huge trend started off of that. So let's go to the daily chart, back to the daily chart. And now you can see we have pinpointed our supply zone a little bit better. The price came very close to it. It didn't fully reach into it, but came very close. And there's often supply and demand radiating around the supply and demand area. So the market came close to it, gave us this doji pattern here. And then after the doji pattern, you can see 1, 2, 3 weeks of bullishness. Again, a few hundred pips, just looking at those 3 candles. And at the core was this doji pattern, which is a decelerating pattern. A doji means that the market forces are undecided, the bulls versus the bears. This is the constant battle that is going on behind the scenes. And a doji shows you that there's indecision in the market. And indecision after such a strong bearish move can often indicate potential reversals or potential trend change. Obviously, just having a doji on a higher time frame isn't enough. You need to go down to the lower time frame and pinpoint the entries based on specific rules or clues. But this is the first good starting point. I hope you enjoyed this introduction into candlesticks. And if you want to know more about my way of trading, make sure to click on the link in the description, the daily bias course. And there I explain my complete strategy top down.